3.
Well, hello everyone. My name is Robin Dolezal. Today is Wednesday, May 3rd. With me as always is Dan Entel and Alex Pars. Together we are with Ironwood Financial. Good afternoon, gentlemen.
How's it going?
Good afternoon.
Happy spring, guys.
Yeah, and happy birthday to my middle son
Oh, good. Today?
today.
Nice. Henry, right?
How old is he?
Finn turned 18.
Oh, Finn.
I can't believe it.
18. That's crazy.
18?
Isn't that nuts?
Yeah.
That is really nuts.
I know.
Yeah.
Hopefully my daughter sees this video so she'll actually wish him a happy birthday.
Right. Well, it is warming up a little bit. Actually, we're getting a little like a couple days of coolness. And I think last weekend was pretty warm. My boys have started to swim in the pool. I am not quite brave enough to do that yet, but June, our summer doesn't actually officially hit till like June 21st.
That's based on everyone's calendar, Robin.
Right. Yeah, ours too. Anyway, well, we are meeting. The Fed met earlier yesterday and as well today, so that's why we timed our videos. As always, we want to get a little start off to what's going on in the market, Dano.
Well, interesting that the market did not like what Dr. Powell said. Reading a bunch of articles, most people, the market had priced in, if you believe in such a phenomenon, that they were going to do exactly what they did, 25 basis points. As we've said many times, Dr. Powell tells us what he's going to do, then he does it, and then he tells us what he did, and he doesn't ever deviate. What they were hoping for was a little bit different language. They were hoping that the Fed would say, we're going to take a wait and see approach from this point forward, and he definitely did not say that. He said inflation is being more persistent and there'll probably be more rate hikes, and that's right when, if you look at the markets, right when that came out and people started reading the text, the market just flipped.
Mm-hmm.
Reality is they're disappointed about the language, but I kind of believe that most of the money it goes where they think it's going to be. And if you look at the treasury yields on the 3, 6, 9, 1, 2, it's still showing an inverse yield curve, meaning a 3 months paying more than a 6 months, 6 months paying more than a 9 month, and 9 months paying more than a 1 year, et cetera, which makes me believe that the people that are in the know realize that we're pretty well done with rate increases. Will we see another one? Who knows, but it'll be insignificant. And I think Alex has some stats as to when the interest rates were this high, and it's not as shocking as you would say. He did mention a great deal about banking. So we saw gold jump above 2,000, which we haven't seen since the fiscal crisis of 2008. We saw oil prices go down. I guess normally oil goes up during the summer, or at least gasoline does, but oil prices are down. And then the market, I almost think the real reason the market flipped is we saw some big pharmaceutical companies miss earnings. We saw like Amgen really come in low. We saw Walgreens and CVX really get crushed. I think actually the street maybe cares more about that. And if you look at when they announced the Fed rate and when Walgreens came out, they coincide almost exactly. So I'm not overly panicked about this. I still like the idea that we can get reasonable yields on bonds. I mean, I'm looking right now. This morning, a 3-month treasury is paying about 5.01. Now it's almost 5.23. So some really nice places for people to place their safe money. And if you look at the long-term outlook for rates, it looks like they're going down, which should bode well for the market. So I don't know that we learned a whole lot today. He did exactly what he said he was going to do, except we had a couple companies miss earnings.
Yeah. This was their third meeting this year, and third time they did a quarter point. Alex, I know we were talking about that chart just before we jumped on. Do you want to share that, and we'll talk about the raises so far this year, or the increases?
And this is just a chart off of Yahoo Finance, but it's interesting because it puts it in perspective. So people are freaking out about these really rapid, significant rate hikes. Look back to 2004. That doesn't look all that different to me.
No.
Okay. And if you notice the upper bound at 5.25, 5.25, and we were higher than that in 2001. So this is, or 2000 rather, this is not, 1970s type rate hikes. This is just getting back to kind of a more normal period after a long period of very low interest rates because of the Great Recession. So I thought, again, this puts it in perspective that what the Fed is doing is not hammering us over the head. They're not, trying to pound us into the ground. This is going back to more business as normal as opposed to what we've seen for the last decade.
Alex, can I ask you a question? Just as we've been talking about this for quite some time, and looking at that chart kind of dawned on me. As we see a 3-month treasury paying almost 5.3%. 2008 when they started raising rates, or 2004 when they raised rates, or 2016 or 17 when they raised rates. I don't recall bond yields actually rising up with it. Where's the disconnect?
I don't remember that either. I remember the rates haven't been like this since the late 90s, early 2000s. But those were higher too, if you recall. I think money markets were 6.5, right?
Oh yeah.
So there was a disconnect. I mean, remember that period where the rising rates was them trying to put a cap on the real estate bubble, and that was what everybody was putting their money into. So it wasn't people looking to say, "Hey, let's go buy some bonds for safety." It was full risk on, because that was, how much money can I make on my negative amortization mortgage in 3 months? I mean, I remember reading an article about the Silicon Valley where they're saying the average home prices were going up $25,000 a month.
Right.
And, so I don't think the money fled into bonds like they're doing now, where, people are saying, finally, after all these years, we're seeing decent interest rates. Then 2004, 2000 wasn't too far away from 2004. So.
What's interesting, at the beginning of the year, I really thought these raises rates would bring real estate down, and it doesn't seem like it's done that all that much this year.
No, it hasn't. And again, that's the inventory problem, because you're not selling your home with a 3% mortgage to get a 6.5% mortgage. It's just not going to happen. So you don't put your house on the market, so the market isn't flooded with supply, so prices don't go down.
Yep.
I mean, eventually that could be a problem, and it was briefly, but my understanding is real estate has turned around and headed positive again.
Yeah.
Alex, as I've been receiving some emails lately, and it seems like there's 2 themes, and I was wondering if you could maybe address them, as you often do when I ask you for help with some of those. But get a lot of conversations about what's going to happen with the debt ceiling, and should we be concerned about that? And probably in the greater, and actually in my opinion, more appropriate question is, what happens if the Fed overdid it and we come into this huge recession? If you would, like you've done for me, would you give us an idea of what your thoughts are on that?
Yeah, there was something funny. I guess Powell addressed the debt ceiling issue, where he said, we don't comment on fiscal stuff. If you guys don't pay your bills, that's your problem, basically. That's not our job. So the debt ceiling, again, we've talked about this before, but it happened years ago where we defaulted and we didn't pay our bills for a few days and nobody really cared. Again, I thought it was really funny. They put tape across the park benches so you wouldn't sit on them because they were closed.
Right.
So again, if the politicians have their way, I mean, I would make it very painful if I were the Democrats, I'd make it painful to not raise the debt ceiling. And the Republicans are going to have to fight down to the last minute, and eventually there'll be a compromise, and it probably will be very minimal, and both sides will say they won. So I don't anticipate that being a major impact on the financial markets, because again, no Republican nor Democrat is willing to see funding to the military stops, funding to Social Security checks to stop, Medicare, things like that.
Yeah.
So the bills are going to get paid, and the closer we get, the more creative ways they're going to find to shuffle the money around that it's not that noticeable to the average person. So on the other one, which is, is it going to be a hard landing? I just pulled up a chart the other day, which was kind of surprising to me. This is the balance sheet, okay, which, we talked about this before, but it's a really quite interesting graph. If you look at this, this is the, reserves. And then we started with the financial crisis and boom, dropped another $1 trillion in to stimulate the economy. And then over the next several years, we dropped a total of $3 more trillion. So a total of about $4.5 trillion to get us out of the Great Recession. And then we started to slowly bleed that off. And then the pandemic hit and we dropped that right up to 9 trillion from about 4. So $5 trillion right away. And presto, we've got inflation. So what's the Fed do? They start their fight on inflation, reducing the balance sheet by about $95 billion a month. Okay, again with a B. So now we have this little banking crisis back in March. And the argument I'm making here is how flexible and how nimble the Fed can be. So you see this little blip right here? That's about $500 billion, okay, that they injected in the middle of March to fix the banking crisis that we had with Silicon Valley and a couple other banks. So, and then they said, yeah, things are fine. Let's start, we'll continue unwinding. So this chart's very interesting to me, and it's just the ability of the Fed to react amazingly quickly. You can see them reacting, to the tune of several $1 trillion in a matter of weeks, or $500 billion in a couple of days. We start seeing something go wrong, a hard landing, all these things that the media would have you be afraid of, and they can just turn that on like that. So again, we didn't have these tools prior to 2008. This was not something they fiddled with. Again, I guess I should have kept sharing that, but look at this chart here. Doesn't go anywhere,
Right.
For years and years and years. And then suddenly we figured out how to play with it, and it's kind of been our magic bullet for getting ourselves out of a crisis so far.
Yeah.
And it's worked.
Do you still have that chart up? Could you look up the jobs available one? That's an interesting one too.
Yeah, that's an interesting one. That's the other one we look at, which is what I believe is causing inflation. Okay, so this is the number of total jobs available that are unfilled. Again, for reference point, when things were terrible in 2009, we still had 2 million jobs available. Right before the pandemic, 7 million jobs. Last March, 12 million. And then the Fed starts raising interest rates, and it's not a smooth downward decline. The job market has been very resilient, very hard to make a dent in, just because of all that money that they printed and gave out. And so finally, we're now seeing 3 months in a row of significant declines. So hopefully this, leads back into what Chairman Powell was saying today, which is, we have to give some time for the moves we've already made to take effect in the economy. And, hopefully we continue to see that downward trend over the next couple of months, shed another couple million available jobs, and then we have inflation under control, hopefully.
Yeah.
But it leads credence to the idea that we won't continue to raise interest rates. And they did change their language today. They said, as opposed to how much more we're going to have to raise interest rates, whether or not we're going to have to raise interest rates.
Right.
And they left their year-end target at the same place. So at the moment, they're thinking they might not have to. So we'll see how the market reacts in the next few weeks.
Yeah, well, we got our meeting, and usually the market kind of relaxes after the meeting. So maybe we'll get some nice growth for the next few weeks before they meet again. We've got our next Fed meeting June 14th, so we'll probably do another video then.
Yeah.
And see what happens at that point. See if they raise rates by another quarter point, or if they stay and they sit on their hands for a little bit. Anything else you guys want to chat about?
Would you say, and I know we're heading into summer, which oftentimes provides the doldrums of the market where not much happens, but what about, would you say it's still a goal that we're hoping for a little bit of rally, maybe get the S&P up around 4,300 and then try to pull some equities out the table and buy some of these bonds that are paying some pretty good yields? Or would you think that's probably, by the time that happens, it could be full-blown rally time, or are we still hoping to pull some risk?
I was hoping for a little bit higher number than 4,300, more like 4,500 or so.
Oh, okay.
Because the PE ratios still support the ability for the market to come up. I mean, it's still inexpensive when you look at PE ratios, and I don't want to jump out too soon when the stock market's low. Yes, bonds are attractive, but if the Fed's statement is accurate, and the sentiment that they're, projecting today, which is that interest rates might stay up for longer than anticipated, then we have some time. So unfortunately, we are still in the, are we there yet?
Gotcha.
Phase.
Right.
But, at this point, we feel like we can see where we're going. But we're still asking that question.
Right.
Makes sense.
So,
All right, folks. So if you've missed any of our other discussions or videos, you can find them on our Facebook page or our website, ironwoodfinancial.com. If we have not addressed any of your issues and you have questions, you can reach us at 520-318-4600. Gentlemen, I appreciate your time today. Great to see you. And we will see you again very shortly.
all right, take care.
Thank you, guys.